Loans can help you grow, but they can also quietly destroy your wealth. One wrong borrowing decision can create years of financial pressure. Most people don't lose money from loans, they lose control. If you don't understand loans properly, they become a long-term financial trap. One of the biggest loan mistakes is borrowing without a clear reason. Many people take loans for convenience or lifestyle upgrades. This creates immediate comfort but long-term pressure. When a loan does not generate value, it becomes a burden. You are committing future income without any return. Over time, this reduces your financial flexibility and control. Smart borrowing always has a clear purpose and expected outcome. Without purpose, debt becomes unnecessary and harmful. It limits your ability to save and invest effectively. Many people fall into this trap without realizing it early. Borrowing should always be strategic, not emotional. Purpose is what separates useful loans from damaging ones. Clear intention protects your financial direction. Without purpose, debt becomes a long-term problem. Interest is the hidden cost that makes loans extremely dangerous over time. High-interest loans grow quickly and become difficult to manage. What seems affordable at first becomes expensive later. A large portion of your payments goes toward interest instead of reducing the actual loan. This slows down your progress and increases the total cost significantly. Many people ignore interest rates when taking loans, which becomes a costly mistake. Over time, interest quietly consumes your income and limits your financial growth. The longer you delay repayment, the worse the situation becomes. Understanding interest is essential before borrowing money. Lower interest means better control and less pressure. Ignoring this factor can destroy your financial future. Interest grows silently but powerfully. What you ignore today becomes a burden tomorrow. Using loans to fund lifestyle expenses is one of the most damaging financial mistakes. Buying things you cannot afford with borrowed money creates long-term problems. These purchases do not generate income or value in return. This means the loan becomes a pure liability from the beginning. Over time, multiple lifestyle loans increase your financial burden. Monthly payments rise while your income remains the same. This reduces your ability to save, invest, and grow financially. Many people fall into this trap trying to maintain a certain lifestyle. But this behavior leads to long-term instability and stress. Smart individuals avoid borrowing for consumption. They use loans only when there is a clear return or benefit. Lifestyle debt destroys wealth instead of building it. Temporary comfort creates long-term pressure. Spending on status weakens financial strength. Many people take loans without properly understanding their repayment ability. They focus on getting approval instead of planning how to repay it. This creates a dangerous financial situation over time. When payments become difficult, stress and pressure increase. Financial stress affects your decisions and overall stability. Missing payments leads to penalties and additional charges. This makes the situation worse and harder to recover from. A strong financial approach always considers repayment capacity first. Loans should fit comfortably within your income, not stretch it. Without this balance, financial problems become unavoidable. Planning repayment is just as important as taking the loan. Ignoring this step leads to long-term financial stress. Poor planning creates constant pressure. Smart planning creates financial confidence. Managing multiple loans at the same time increases complexity and financial pressure. Each loan comes with its own interest rate and payment schedule. This creates confusion and reduces your control over money. Over time, managing multiple obligations becomes stressful and difficult. Missing even one payment can lead to penalties and added costs. Many people take new loans to cover old ones, creating a dangerous cycle. This cycle becomes harder to break as debt increases. Financial clarity disappears when too many loans are involved. Reducing the number of loans improves control and stability. A simple financial structure is easier to manage effectively. Multiple loans weaken your financial system. Less debt means more control and better growth. Simplicity improves financial clarity. Fewer obligations create stronger stability. Many people sign loan agreements without fully understanding the terms and conditions. This leads to unexpected costs and hidden charges later. Loan agreements often include details about interest rates, penalties, and repayment rules. Ignoring these details creates financial surprises. Over time, these hidden costs increase your total debt. Smart individuals take time to understand every condition before borrowing. This awareness helps them avoid unnecessary expenses. It also allows them to make better financial decisions. Understanding terms gives you control over your commitments. Lack of understanding leads to costly mistakes. Always know what you are agreeing to before taking a loan. Clarity prevents hidden losses. Awareness protects your financial decisions. Delaying loan payments is a mistake that quickly increases financial pressure. Late payments lead to penalties and additional interest charges. This increases your total debt and makes repayment harder. Over time, repeated delays create a cycle of financial stress. The longer you delay, the more difficult it becomes to recover. Consistent and timely payments are essential for control. They help you reduce debt steadily and avoid extra costs. Discipline in payments keeps your financial plan stable. Without discipline, debt grows faster than expected. Staying consistent with payments is key to avoiding problems. Timely action prevents long-term damage. Delay increases cost and pressure. Consistency reduces risk and stress. Taking a loan without a proper financial plan increases risk significantly. Many people borrow money without knowing how it fits into their overall finances. This leads to poor decisions and unnecessary pressure. A financial plan helps you manage loans effectively. It ensures that borrowing aligns with your goals and income. Without a plan, money is used without direction. This creates confusion and reduces control. Over time, this leads to financial instability. Planning allows you to use loans wisely and avoid mistakes. It keeps your actions structured and intentional. Loans should support your plan, not replace it. Structure creates better outcomes. Planning protects long-term financial growth. Many people take loans based on emotions rather than logic. Stress, pressure, or desire can push you into unnecessary borrowing. Emotional decisions often ignore long-term consequences. This leads to poor financial outcomes and increased debt. A strong mindset helps you stay calm and think clearly. Logical decisions reduce risk and improve control. Borrowing should always be based on need and purpose, not emotion. Over time, emotional discipline protects your financial health. It helps you avoid unnecessary commitments. Controlling emotions is essential when dealing with loans. Clear thinking leads to better financial choices. Emotions create mistakes and regret. Discipline creates stability and control. Relying heavily on loans creates financial dependency over time. Instead of building your own financial strength, you depend on borrowed money. This reduces your ability to grow independently. Over time, this habit weakens your financial position. It limits your ability to save and invest effectively. Dependency creates stress and reduces flexibility. Smart individuals use loans carefully and only when necessary. They focus on building their own resources and assets. This creates long-term stability and control. Loans should support growth, not replace income. Reducing dependency strengthens your financial future. Independence builds confidence and stability. Self-reliance creates long-term financial power. Loans are not always bad. They become dangerous when used incorrectly. Smart borrowing can support growth when used with discipline and planning. The key is understanding purpose, interest, and repayment clearly. When used wisely, loans can create opportunities instead of problems. But without control, they destroy wealth and stability. Discipline and awareness are essential for managing loans effectively. Over time, good decisions protect your financial progress. Avoiding mistakes is just as important as making the right moves. Your approach to borrowing determines your financial future. Control your loans, and you protect your wealth. Smart decisions build long-term security. Controlled borrowing creates lasting financial strength.